All right, so this is SPX 112 bear trap. We put this trade on 21 days ago. There was an adjustment that we needed to make, and you can look at a chart here. The first green dot is when we took the trade. The market had pulled back. This was on March 10th, so just over a week ago. The position was threatened. It wasn't too bad, but the market started to roll over. Implied volatility started to increase. So what I ended up doing is I ended up buying to close one of the short puts, which was the short leg of the 3,900 38.60 put debit spread. This flattened my T plus 0 on the way down, and since the market has kind of, I don't want to say it bottomed out, but it's definitely trading away from the price level where we were when I made the adjustment. So I put the hedge on. Now the market's moving higher. This position is now accumulating negative delta, which is not a big problem. There are still 31 days until expiration, and there are several ways that we can go about potentially removing upside risk. Remember, we started this trade. We had a net intake or net credit that we took in was about $5,000. Buying one of the 38.60s, I spent just over $10,000 on buying back one of the short puts. So now I went from being at a surplus of $5,000 to a deficit of $5,000, right? So I spent $10,000, spent the $5,000 that I took in, and I spent $5,000 more on top of that to put this hedge in place. So now my goal is to retrieve or take back $10,000 out of the market, right? To kind of put myself back into similar position where I was when I first took this trade. Now we do have the Fed meeting tomorrow. I'm not going to talk about what I think or what I know, but one thing I do know for sure is that the market is moving higher, and if the market continues to move higher, if I do nothing else, right, this trade on the upside has a risk of almost $6,000. So if I do nothing else and just hold it for the next 31 days, as long as SPX is above 3,900 at expiration, this trade is going to be out about $6,000. So now I was looking at several different adjustments that I could potentially make here. And the reason why I wanted to talk to you about this in the first place is because we all trade different account sizes and we all can't make identical adjustments when we need to make adjustments. So I just want to show you my thought process and the way I look at things when I look at adjustments. And hopefully you are able to apply very similar methodology, if you will, when it goes to making adjustments. So as I always say that, when I start to look at adjustments, I start at a place of where am I trying to get to? Like, what am I trying to accomplish here? So right now, right, this position is negative 13 delta, right? My goal going into tomorrow, at least until tomorrow or maybe Thursday of this week, I want to keep my delta flat. I don't know if the market's going much higher tomorrow. I don't know if the market's going much lower tomorrow. What I want to do is I need to get to delta 0, right? This is a net delta. This is if we took the delta of all of my longs and all of my shorts, right? Where short more puts down here at 34.50. If I took all of the deltas and I combine them all together, multiplied by the number of contracts, right now this position is short 13 SPX delta. So what that means that in order to get to delta neutral, I can go ahead and buy one 13 delta call, which is not what I'm going to do. I think this is an absolute wrong adjustment, and I'll show you why. Right, buying, sure, it gets me to a delta 0, but it doesn't really eliminate the problem that I have. My problem here is this potential area where I'm going to lose money if the market rips higher. So buying a call here does get me to delta 0, but I also need the market to move right about 7 or 8% in the next couple of days to make up for what I would be paying for this 13 delta call. So buying calls, just looking at the delta by itself is not the right thing to do. So buying a call is really not a good idea. And I'm sorry if I confused anyone starting off with buying a call. I just wanted to show you that just to get to delta 0, there's a wrong and there's a right way to do it. So buying calls, committing more capital, right, putting more money into this trade, paying a debit is really not the idea. I need to figure out a way to get me to a delta 0, but I also need to try to recover some of the $10,000 that I spent when I put the first hedge in place. So one way to do it, right? Let me just start off with what I'm going to do. So I know that I'm short 13 delta. If I sold a 13 delta put, right? If I sell a 13 delta put, that's going to add 13 delta to my net delta position, or net position, net delta of this position. So if I just sold one 13 delta put, which happens to be 37.05 right now, you can see that my delta goes from minus 13.4 to minus almost flat, right? Minus 0.4. This also is going to bump my theta just a little bit. So these are all great things, but my vega is also going to increase, which means that if going forward implied volatility is going to increase, I get the benefit of faster decay. I get more theta. I don't really have a lot of directional exposure, but volatility is going to be a problem for me. So that's one way to look at this. Well, somebody can say, well, I can't, because selling a 37.05 here, it's going to take up quite a bit of margin because we're adding one more naked put. Now, I don't know what your situation is, if you're trading in the portfolio margin account or how much buying power you may have available. If that is the case, that you cannot sell another naked put, well, there are other ways that we can potentially shave off, right, this negative 13 delta. How about, right, we know we have this uneven long put debit spread, right? We're long 5 3900s, we're short 4 3860. So technically you can say that we have 4 of these 40-point wide put debit spreads with an extra long put at 3900. So if I was to look at just removing one of the 3900 3860, so I would be selling to close the 3900 and I'll be buying to open buying to close 3860, right? So I'm just closing one of these put debit spreads. That's currently going for $8.80 credit, which is good, right? I'm trying to collect the credit. I need to replace the $10,000 that I spent putting the hedge when the market was rolling over. So I'm collecting a credit. That's great. I'm also selling a put spread. Now we know that selling a put spread adds positive delta, and we can see that we go from minus 13 to about minus 8. So one of these put credit spreads will have a positive delta of about 5. So now I say, all right, what am I going to do? I could do maybe 2, right? I can sell to close 2 of these put spreads, and that's going to take my delta from minus 13 to about minus 3. So I'm not quite getting to, negative, not getting to a delta neutral position here, but I'm definitely removing 10 of the 13 negative deltas, and that's going to also raise my risk graph at expiration T line, which is this green line here. So from here, right, if I do this, This is going for $880, so I collect about $880. If I do two of these, I collect about $1,700 or so dollars, and I still don't fully recover the $10,000 that I spent, but you can see that my risk on the upside is now less than it would be if I did nothing. And that comes at an expense of potentially shrinking the size of the profit tent, or the bear trap, if you will. Right, so that's the trade-off. And let's look at the Greeks. So what happens here is that selling two of these put debit spreads will take our net delta down. That's a positive. It'll increase our gamma, which means on the downside, we are going to be a little bit more sensitive to price movement. Our theta is going up, so that's positive, right? We're getting a little more decay per day in this new position, but our vega is also going to increase, our negative vega, which means that if implied volatility starts to increase going forward, T+0 line is going to get pushed lower, and this trade is going to be in a little bit of trouble. So two different ways to make this adjustment, right? And doing this in a way of selling two of the 3,900, 3860 put spreads, it doesn't add a ton of margin. Technically, what it will do, and we could figure out how much margin it'll require, right? We're selling a 40-point wide put spread, and we are collecting $8.80. So we have to put up about $3,120 per one contract, or per one spread. We're doing two of these, and the margin is going to increase by about $6,200. All right, so if you compare selling one naked put in SPX to open, in my mind, I believe that it'll take up more buying power than selling to close the two 3,900, 3860 put spreads. So two different ways to approach. They both achieve pretty much the same, right? My goal is to get to delta neutral or close to it. And at the same time, I need to collect the credit. I don't want to pay a debit. I don't want to put more debit into this trade. I already spent $10,000 when I made the adjustment to fix my T+0 line on the way down. Now I'm trying to figure out a way, how do I raise my T at expiration line back above this zero line. All right, I have 31 days to figure things out. I'm going to start by, what I'm going to do is I'm going to go ahead and just sell one 13 delta put, maybe a 12 delta put. I'll sell it 3,700. Right, so this is going to bring in about $18.55. Remember, we talked about two selling to close two put spreads at 880 times 200. That's $1,760 credit. Selling a $3,700 put is going to bring in $18.50, or $1,850. So we're bringing in very similar credits. We're achieving very similar adjustment by taking our net delta close to neutral, but doing the put spread is going to take up a little bit less buying power. If you have the buying power, I think the easiest thing to do is to sell to open the $3,700 put. If you don't have the buying power, I think going with selling to close two of the 3,900, 3,860 put spreads is the better way to do it. I hope I didn't confuse you more. If I did, feel free to ask questions. I'll make this adjustment. I'm going to sell to open a $3,700 put. I'm going to try to collect about somewhere between $1,800 and $1,900, and I will make any further adjustments as necessary, and I will most definitely either make another video or I'm going to write about it.